Okay, let's unpack this. Today we're doing a deep dive into a property investment strategy that, well, it adds quite a layer of structure, buying property through a trust.
Yeah. It's something a lot of sort of more experienced investors think about, but it's definitely not the straightforward path, is it?
Not at all. We've been digging into some material on this, specifically an article from Digital Finance Solutions called Buying Property Through a Trust.
Right.
And our mission, really, for this deep dive is to try and cut through some of that complexity. We want to get to the core of what a trust actually is here.
Yeah.
Why someone might choose this route, the real advantages, and some might surprise you,
Yeah.
but also, crucially, the potential, downsides and the tricky bits.
Absolutely.
The idea is for you to walk away with a solid grasp of the concepts and the big picture.
And what's interesting is, at its heart, a trust is, well, a fairly simple legal idea, isn't it?
Hmm.
But applying it to assets like property, that's where it gets powerful.
Okay.
Think of it like setting up a kind of dedicated box, maybe. You have a trustee,
Right.
and their job is basically to hold and manage assets, the property, in this case, but on behalf of other people. Those are the beneficiaries.
So hang on. The key thing then is if I buy a property and a trust, I don't own it personally.
That's exactly right. The trust owns it legally. The trustee's name is on the title, but they're holding it strictly for the benefit of those beneficiaries.
Oh.
And the trustee isn't just making it up as they go along. They have a rule book. It's called the trust deed.
Right, the deed.
And they must manage the property following those rules. Any money that comes in, like rent or even, capital gains if it's sold,
Yeah.
that belongs to the trust. But importantly, it can often be distributed out to the beneficiaries. How and when, though, that really depends on the specific type of trust you set up.
Okay, so it's like creating this separate little entity almost to hold the asset and manage it for certain people. Why? Why go through the hassle and the cost? What's the big why the source material points to?
Yeah, that's the million-dollar question, isn't it? The material highlights several really big drivers.
Hmm.
First up, and often top of the list, is asset protection.
Ah, okay. Like a shield.
Exactly like a shield. By holding the property in the trust, if something goes wrong in your personal life, maybe a business fails or there's a lawsuit, something like that.
Mm.
Your personal assets could be at risk, sure, but the property sitting safely inside that trust structure is typically protected from your personal creditors.
Right, that makes sense. Keeping things separate.
Totally separate. Then there's tax planning flexibility. This is a big one, especially for families using what's often called a discretionary or family trust.
How does that work?
Well, the trustee often has the power, the discretion, to decide how to distribute the income the property generates, like the rent, among different beneficiaries in the family each year.
Oh, I see.
So you could potentially distribute income to family members who are on lower tax rates, which might reduce the overall tax bill for the family group.
Okay, interesting. Tax optimization. What else?
Estate planning is another huge plus. Assets held in a trust, they don't actually form part of your personal estate when you pass away.
Right, so they bypass the will, sort of.
In effect, yes. It can make passing assets to the next generation much smoother, potentially avoiding the time and expense of probate. And it gives you more control right from the start over how those assets will be managed and distributed way down the track.
Okay. Control and smoother transition.
Yeah. And one more thing the material mentions is land tax strategy. Now, this is very state-specific,
Uh-huh.
but in some Australian states, the way land tax is calculated can be different for properties and trusts versus those held personally. Depending on the rules where you are and how many properties you have, maybe spreading them across different trusts could potentially lower your overall land tax. But you really need to check your local rules.
Okay, yeah, that land tax one sounds like you definitely need specific advice for your state. But here's something that really jumped out, and the source highlights it as a pretty significant advantage for investors trying to grow. Improved serviceability for lending?
Ah, yes, this is
So
critical.
this sounds a bit backwards, doesn't it? How does putting a property into a trust actually make it easier for me to borrow more money personally? Explain that link.
Right. It does seem counterintuitive, but this is a really key point for serious investors looking to scale. What happens is when you go to apply for a new loan personally,
Like for my own house or another investment in my name.
exactly, some lenders, and it's important, not all lenders, but some have policies where they might not fully count the debt and the income from properties held inside your trust structure when they're working out your personal borrowing power.
Hang on. So the bank might look at me personally and sort of ignore the trust's mortgage to some extent.
To some extent, yes, for some lenders' assessments of your capacity. Think of it like this. Your trust is over here, running its own portfolio. It's got its own income, its own debts. When you, the individual, go to a bank for a separate loan, the trust's activity for those specific lenders doesn't drag down your personal borrowing ability as much as if all those properties and all those loans were just bundled under your personal name.
Wow. Okay.
And that separation is gold for scaling. It means your trust can hold your existing investment properties, potentially freeing you up to still qualify for pretty decent loans in your personal name. So you can use borrowing capacity both within the trust and personally, and they don't necessarily limit each other quite so directly. It lets you grow faster.
That makes a huge amount of sense. Separating the investment engine from the personal balance sheet, kind of. Okay, so just to be crystal clear, a trust can legally own property in Australia.
Yes, absolutely. The trustee holds the title for the beneficiaries, no question.
And a trust can borrow money, get a mortgage to buy that property.
Yes, definitely. Trusts take out loans all the time for property. But, and this is a big but, this is where some of that complexity we mentioned really kicks in.
Right. It's not just like getting a normal home loan.
Not at all. Getting finance for a trust is different. First off, not every bank or lender even offers trust loans.
Okay. Fewer options.
Fewer options, and you'll typically need way more paperwork. Not just your personal stuff, but the full trust deed, financials for the trust itself. It's a bigger application process.
Sounds like it.
And lenders nearly always require guarantors for a trust loan. Meaning individuals, maybe you, maybe other directors, if it's a corporate trustee or even another company, has to personally guarantee the trust's debt. So if the trust can't pay, the guarantor's on the hook.
Ah, okay. So there's still personal risk linkage there through the guarantee.
There usually is, yes. And just generally the lending policies, the credit criteria, they tend to be strict, more conservative for trusts compared to lending to an individual.
So definitely more hoops to jump through, maybe tighter conditions, which is, I guess, the trade-off for that potential serviceability benefit we talked about.
Exactly. It's a balance.
You mentioned different types of trusts earlier. What are the main ones investors use for property, according to the source?
The most common one, the material says, is the discretionary trust. You often hear it called a family trust.
Right.
Its main feature is that flexibility the trustee gets to decide, or has the discretion each year, about how income and capital are distributed among a group of beneficiaries, usually the family. That's why it's popular for that tax planning aspect.
Okay. The flexible one. What else?
Then you've got the unit trust. Think of this more like owning shares in a company. Beneficiaries own fixed units or shares in the trust.
Ah, so it's fixed percentages.
Exactly. Clear ownership proportions.
Yeah.
So it's often used when, say, unrelated people are pooling their money to invest together. Everyone knows exactly what slice they own.
Makes sense for joint ventures.
Yeah. And the source briefly mentions hybrid trusts, too, which kind of mix features of both, but apparently they're less common because they can get even more complex.
Got it. Discretionary and unit are the main players. Now, what about the trustee itself? The entity or person managing it? Can I just be the trustee, or is it better to set up a company? Does the source give any guidance there?
It does, and it's a really important point. You can have an individual trustee. So just a person, maybe you, acting as the trustee.
Okay.
The source notes this is usually simpler and cheaper to set up initially. However, and it's a big however, the significant risk is that if you're the trustee as an individual, your personal assets could potentially be on the line if there are legal issues or debts related to the trust. There's less separation.
Ooh, okay. That sounds risky. What's the alternative?
The alternative is a corporate trustee. This is where you set up a specific company, usually a proprietary limited company, and its only job is to act as the trustee for that trust.
Right, a dedicated company.
Exactly. Now, this costs more. You've got company setup costs, annual ASIC fees, more compliance. But the huge advantage is better asset protection. The company, as the trustee, is the legal entity facing the liabilities. It creates a stronger barrier between the trust's obligations and your personal wealth.
Ah, so the company takes the hit, potentially, not you personally.
That's the idea. Plus, it can make things like changing control or beneficiaries easier down the line compared to changing an individual trustee.
Okay, so that trustee choice, individual versus corporate, seems pretty critical for managing risk. We've covered the benefits, how it works. Let's flip the coin. The source is clear this isn't all smooth sailing. What are the key risks and things to watch out for?
Absolutely. There are definite trade-offs. The first one is just the cost. Setting up a trust properly isn't free or even cheap. You need lawyers, accountants.
Right.
The source estimate setup could be anywhere from, say, $1,000 to $2,500, maybe even more, depending on complexity.
Okay, so upfront costs.
And crucially, ongoing costs. You've got annual accounting fees for the trust, tax returns for the trust, compliance stuff, plus those ASIC fees if you go with a corporate trustee.
Wow.
There's another layer of admin and expense every year.
Adds up. What else?
A really key limitation, especially if you're thinking about properties that might lose money initially, negative gearing.
Yeah.
Trusts generally cannot pass those property losses through to the individual beneficiaries to offset their personal income.
Oh, right. So
Usually.
if the property's negatively geared in the trust?
Those losses are typically trapped inside the trust. They can usually only be used to offset future income within the trust, or maybe future capital gains in the trust. You lose that immediate personal tax deduction you'd get if you owned it in your own name.
That's a big one. That can be a significant tax disadvantage, especially early on.
It really can be. Then, as we touched on, financing is just harder.
Right. Fewer lenders, more paperwork.
Tighter criteria. You might not get the
Mhm.
same loan terms or flexibility as you would personally. Less choice. And that land tax point, again, while it could be a benefit sometimes in other situations, maybe with smaller portfolios or just one property, the land tax bill for a trust might actually be higher than holding it personally. It really depends on the specific state rules and thresholds. You have to check.
So definitely adds cost, complexity, you lose that negative gearing pass-through, and borrowing is trickier. Given all that the good and the bad, who does the source suggest this strategy really makes sense for? Who should be considering it?
Yeah, the material's pretty clear. It's not a starting point for everyone. It's typically looked at by investors who see property as a serious long-term game plan.
Okay, long-term focus.
Definitely. People planning for future generations, thinking about succession planning, how assets will eventually move down the family line, or those who really prioritize having more control over tax outcomes, and very importantly, that asset protection aspect.
Right, protection and planning.
And they hammer home the point, and it's critical advice. Anyone even thinking about this must talk to their accountant and a legal advisor before doing anything. It's absolutely non-negotiable.
Their expertise is vital to figure out if it actually fits your specific situation and goals, and to make sure it's set up correctly. Get it wrong, and it can be messy and expensive to fix. The source also notes that specialist brokers, like Digital Finance Solutions themselves, can help navigate that tricky lending side for trusts.
Yeah, that professional advice piece sounds absolutely crucial. You really need to know what you're signing up for.
Okay, so quick recap then. Using a trust adds definite complexity, costs money upfront to set up, and costs money each year to run.
Higher barrier to entry, more ongoing admin. That's the baseline.
The trade-off is you get potentially very strong benefits, robust asset protection, more flexibility for family tax planning, maybe a smoother estate planning process. Potential, though complex, land tax angles in some places, and that really interesting one for growth investors, the ability to potentially scale faster by separating trust and personal borrowing.
It really boils down to weighing those strategic, often long-term advantages against the immediate and ongoing costs, the administrative load, and giving up things like using negative gearing personally.
So if you're thinking about structuring your investments, not just for right now, but with that longer view, growth, protection, maybe passing things on, understanding structures like trusts is really key.
Yeah.
But as we've stressed, getting that tailored advice for your situation, absolutely paramount before you leap.
Couldn't agree more.
Which leaves us with a thought to ponder, doesn't it? When you weigh those big strategic pluses, like the asset protection shield and maybe accelerating your portfolio growth because of how lending might work against the definite upfront costs, the ongoing hassle, and losing out on things like negative gearing tax breaks personally, how does that calculation actually influence your thinking about the best way to structure your property investments for the future? Something to definitely mull over.